Hello, this is Eric Boyce, CEO and Chief Investment Officer for BKA Wealth Consulting, and welcome to Charts of the Week for August 9th of 2021. Please see our disclaimer for important information. We get started this week with our high frequency data, courtesy of First Trust, our friends in Chicago. You can see a little bit of impact here beginning to emerge from the Delta variant and some of the precautions that you see people are taking. You see some areas that are increasing their stage level of emergency management because of the emergence of the virus and number of cases. You can see that particularly in the open table restaurant data week over week, a little bit negative. TSA checkpoint data, a little bit negative. Global flights off slightly for the week, still positive in all three cases for the month, but then you see box office receipts, which is a little lumpy and kind of dependent on new releases, so don't take much stock in that. But we continue to see positive trends in labor. Overall, in terms of unemployment, now there's still a lot of jobs that are hard to fill. We'll see that in a chart coming up. And we do see prices paid moving higher for those positions, overall the data is not bad at all, but it is beginning to reflect that Delta variant issue. Here's a chart that I thought was really interesting. This whole argument of, who's been vaccinated, who's not, and where are the cases coming from, so on and so forth. But I thought this was interesting from the Kaiser Family Foundation. And it basically tells you, if you kind of look at all those little dots and you get down to the bottom below Washington, it's at the zero bound, that this is the percent of fully vaccinated people who have died with COVID-19. That's the kind of this yellow-ish button. The green is percent of fully vaccinated people hospitalized with COVID-19, and the blue is the percent of fully vaccinated people with a COVID diagnosis. And there have been breakthrough cases, and I'm aware of a couple just within my own sphere of influence, but you can see overall that the rate of breakthrough cases in that blue is very, very limited. Of course, you go all the way to the right side of this chart, you're only getting to 5% of the population. So again, fully vaccinated people have extremely low incidence of virtually no deaths, virtually no hospitalizations, and very few actual diagnoses or breakthrough cases. Now I wanted to circle back to something. I found this chart in the pack this week, and this is a look at India. And India was all the conversation about a month ago, and maybe dating back 6 weeks when cases were rising uncontrollably. And it really was a humanitarian crisis because of the low vaccination rates. And you can see here that daily new confirmed cases in India, again, not that this is an indication of herd immunity, but it's an indication that, that these things do come in waves. And I think this is something that we should pay attention to here with regard to Delta. And there's some conversation now that some of the daily new case rates in some of these hot zones like Florida and Louisiana are beginning to ebb and maybe even begin to show signs of rolling over. But all that means is that there's a potential for potential for those case rates to move higher in other parts of the country, but probably not to the same tune that we saw in the Deep South, where vaccination rates overall are much lower. But again, circling back to India, good to see that the Indian cases have gone down. Again, everything is kind of cyclical and in waves, and this is certainly an indication of what has happened here in that occurrence happening here in India. Now we'll kind of dig into some of the data here. This is U.S. consumer spending on some of these high frequency items. And this is just another way of looking at that high frequency data. The blue line represents accommodations, which is hospitality. Food services, we know open table numbers are off a little bit. You can see that tailing off just a bit in that green circle. Arts, entertainment, recreation, same thing going on. Again, I think this is the Delta variant at work. Is it enough now to begin to derail economic growth? No, I certainly don't think so. And again, going to that last chart on India and the caseloads, with as much speculation is being, given right now to to this breakout in Delta variant cases. It is going to roll over at some point, and I think, it's apt to do that at a time that, will allow these indicators here to kind of settle out a little bit before they get too negative. Now, here's a National Federation of Independent Business. This is some of their small business indicators. So you can see on the left-hand side, job openings hard to fill. That number remains exceptionally high. In fact, it's actually gone up a little bit from the last time that we talked about it a few weeks ago. But again, jobs are hard to fill still. Labor market's tight in a lot of occasions. A quit rate for employees is pretty high, and there's a lot of reasons why they're quitting and wanting to work from home, wanting more flexibility, too stressful at the job. And there's just this interesting dynamic going on right now with regard to labor, even if the unemployment rate is going down, long-term unemployment is going down, but there's still choke points in labor right now. And you can see on the right-hand side, as I alluded to a few slides ago, the compensation plans. This is basically, salaries and wages that are expecting that the business owners expect to pay, and that number is going up as well, not too surprisingly. Here's a look at another look at labor, I guess I should say. In the blue is the unemployment permanent job losses. And that's going down. In that orange, you see the number of unemployed on temporary layoff, and you can see temporary layoffs are moving down lower as well. It's just another way to slice it, another way to look at labor. Labor overall is pretty healthy, even if we have some of these choke points where labor costs are probably going to be driven up, but the overall health of labor is actually pretty good. Quick look, a couple slides here related to real estate and residential real estate. This comes from a piece that was written, a very good piece at that, by FS Investments out of Philadelphia. And you can see here on the left-hand side, the University of Michigan Consumer Survey. And this is a question very specifically, is this a bad time to buy a house? And you can see that number really beginning to move higher. And this has been a somewhat cyclical type of indicator, but you can see the breakout that we've seen lately. And we haven't seen a level this high, essentially the percent of respondents saying it's a bad time to buy a house. We haven't seen this level in a long time. Again, prices are real high. On the right-hand side, you can see the month supply of existing homes is exceptionally low. So you've got a lot of buyer frustration out there that prices are high, inventory is low, even though mortgage availability seems to be improving somewhat. You got to find the house to finance it with first, and that's becoming a real problem. Here's national home price appreciation. This is really no surprise to anybody that's been following charts of the week, and I've had charts in here about real estate price appreciation ad nauseum for most of this year. But you can see in this representation again from the same research piece that FS Investments put out that you not only in the Case-Shiller numbers, but the Federal Housing Finance Association (FHFA) purchase only index, those numbers are going much higher year over year. I mean, to the tune of 15 to 20%. Again, I don't think that these numbers are sustainable. Question is, how long do we see rates of growth like this before the growth rate itself begins to peak and roll over? And then housing starts, obviously this is builders in response to the lack of inventory and also the incentive that's born out of price appreciation, that you do have a trend line rise in single family starts, although that number's been a little troubled lately. It's hard to see this if you go to the very, very far right of that chart. You can see where it's off a bit this year, and that has a lot to do with the access to materials and labor. You've got, obviously lumber and other commodity price issues, even though those prices have kind of rolled over from their really exorbitant peaks. It's provided as I'll say it again, an interesting dynamic here where, there's certainly a lot of incentive to build, but there are choke points in being able to get that product to market. Here's housing affordability. It's essentially a mortgage payment as a percent of median family income. And, this is a silver lining in housing when you get right down to it. This number has picked up a little bit, but the mortgage payment, we know rates are exceptionally low with a 10-year yield of, well below 1.5. It's providing the feedstock for lower overall mortgage rates, which does help in terms of calculating this mortgage payment as a percent of median family income. But the number is moving higher just because home prices are appreciating, so new houses being financed are skewing that number because the overall value of the home that's being financed is going up. So here's a chart that I found in a tweet from Lizanne Saunders, which I thought was really kind of neat. U.S. personal consumption expenditures for goods and services is up in the upper part of this. Blue is services and amber is goods, and you can see that those numbers are trending higher. So personal consumption in this area is moving higher at the same time that you've got personal savings, which is well above, in relative terms, where it was pre-pandemic, although it has come off quite a bit from its peak. And you can see this kind of loose positive correlation, if you will, or I guess in this case it would be kind of negative correlation, that when you have increased personal consumption on both of these categories, you're having this decline in personal savings, but we still have a lot of dry powder. Consumer balance sheets are in exceptional shape, notwithstanding the fact that it's being helped by home price appreciation, by increases in asset markets, and notably, the investment markets. Your investments are going up, and your housing value is going up, and so on and so forth. But savings are moving down, kind of in concert with this increase in consumption. And here's a look at the ISM, the Institute for Supply Management Services Purchasing Managers Index. It seems like a lot, but basically this is a look at the service sector. Whereas earlier this year and late last year, we saw it in the ISM manufacturing, which is a much less meaningful component to overall economic growth, and it has, services has a much stronger weight in the overall growth rate of the economy. And so that's why we spend a little bit more time here talking about the services PMI, and that index is moving higher. Again, as I've said before, anything above 50 represents expansion, and anything above 60 represents really strong expansion, and that's where we are right now in services. On the right-hand side, I was able to find a chart that gives you kind of the contribution from various sources. And importantly, we see new orders, we see business activity. We do see supplier deliveries, but supply delivery choke points and the supply chain issues are really, really acute right now. So that number actually would be even greater if we didn't have those choke points. But you can see a broad contribution from a lot of different sources, even including a little bit from employment, although not that much. But business activity is real strong right now. On a continuing thread here on the ISM Services PMI, here's inventory sentiment. And this is where, this whole inventory issue comes into play, and where I think it actually serves as an opportunity looking ahead. So inventory sentiment is just a synopsis of survey respondents that say inventory is really tight. In other words, I don't have enough product to sell. You go to a lot of places. My wife was at IKEA, and they were very depleted of floor stock inventory. And this This is what this number represents right here, this on the left-hand side. Now, backlog of orders is just simply, the kind of the you cause and effect of inventory problems. You've got a large backlog of orders that's piling up because you don't have the inventory to fulfill, and that's going to hopefully inspire additional production for retailers to restock and whatnot. But again, this is kind of the state of the nation right now with regard to the services industry, that it's hard to supply product because you don't have it, and you've got a lot of orders that are kind of building up in the pipeline. And as a result, as we continue along this analysis of the ISM Services PMI, prices paid moving higher, and it's moving higher, to a level that we haven't seen in quite a while, and at least I'd say at least a decade, and it's moving at a pretty pronounced pace. We worry about how this channels into inflation. We know it actually already has, because we see things even at the grocery store we're paying more for. I mean, prices are being obtained in the marketplace from consumers and from original equipment manufacturers and from other people. But this is a service number, so this reflects basically consumer related consumption, and people are paying more for what they're getting. And so going to the right side, I wanted to put this chart on here because this is what the U.S. Federal Reserve common inflation expectations. This is actually what the inflation that the Fed expects. And so, if you look at the left and the magnitude of that rise, you look at the right, that's going up, but look where it's saddled right now. It's like basically just over 2%, which is like almost in line with the Fed's long-term target. So the Fed is not looking at this and telling us, hey, we expect long-term inflation to be really crazy. In fact, their expectations are pretty benign right now. And I think this is channeling into the bond market, and is one reason why we see these low interest rates right now on U.S. Treasuries. I found this chart. I've got a couple of things on the global marketplace, but this one I'll throw in there right now. But this is essentially global investment and global capital spending expectations. And it kind of goes back to my comments over a year ago, when we were anticipating at that point, kind of a synchronized global recovery. And it's been a little less synchronized than I thought perhaps that it would be, but it is actually, an expansion nonetheless. And this is global non-financial corporate capital expenditures. And the blue represents the non-financial energy and materials, which can be a little bit lumpy. But if you track from like 2019 to 2020, we saw a level that has been maintained for pretty much the last decade. And then for 2021 and 2022, that number is expected to spike. And on the right-hand side, you can see, in this chart from Haver Analytics, that in that blue line, which represents the current cycle, that we're expecting global investment and spending to recover at a really sharp pace relative to the global financial crisis back in 2008, 2009. Iron ore, not going to spend a whole lot of time on commodities, but there's a lot of commodities that kind of fit this profile where, they've seen their peaks, they've rolled over from their peaks. Obviously, this is more important to manufacturing than maybe some of the soft commodities, but you can see here that iron ore futures are moving a little bit lower. This is the Evercore ISI apartment survey. Now, this is important to inflation. And as we've seen in the past, we have some inputs that kind of provide some leading indicators for where CPI is going to go, and we could see some data over the last couple of weeks that kind of made us not only realize but also anticipate continued increases in rents. And rents are ultimately something that could filter into the consumer price index and give us more inflation than we've used to. And you can see that these rents have actually rebounded by dramatic amounts. So, the two things that I'm kind of interested in with regard to inflation right now are really labor costs, and we know labor costs are moving higher, and rental costs, which is not an insignificant, housing is not an insignificant component of the CPI calculation. And so, this is one reason here where I think we could see a little bit higher inflation overall, once we kind of roll off these peaks. Here's a quick look at our trade balance. There's so much demand here relative to the rest of the world that our trade deficit continues to grow. You can see that at the top level. And if you back out petroleum, which has become a more meaningful component of trade, particularly on the export side over the last decade, that number looks very similar. Both of these are trending down because of the high degree of demand that we're witnessing in the country right now. Here's a quick snapshot of the S&P 500, and I'd give you two looks here. This is the S&P 500 on the left. In the black, that represents the index itself, and we know that's moving higher. And as I've kind of alluded to in some of the charts of the week and market minutes over the last few months, I mean, the multiple in the market, which is represented in that blue, that forward price to earnings ratio, it's actually moved down a little bit. But as you can see here, it's settling in right here about 21 times earnings, which is much higher than if you go back in this scale and go back to the pre-pandemic, it was about 19 times. So we're more expensive than where we were pre-pandemic, but the multiples have come down. And interestingly, if you move to the right, if you go to the small cap component of the S&P 1500, you can see that multiple has come down a lot more. You see the index itself is kind of meandered about. We haven't had the strength in small caps that we've had in the S&P 500 in the broad index. And in fact, you've seen some outright underperformance coming out of small caps as of late. But you can see from a relative basis that there's more value there, as the multiple is somewhere around 16 times. From a cyclical standpoint, I wanted to show where we were in the S&P 500 as we've kind of made this transition. So early on we had semiconductors, we have autos, home builders, all of these. When you hit the trough in your growth and you begin to recover, which is what we did essentially in April with the shortest recession that we've had in modern history, then these sectors have moved higher. And these are the early cycle sectors relative to the broad S&P 500. And so, these sectors really outperformed last year, and very notably, a lot of the technology stocks. Now we've seen, kind of a peaking in that. We've seen kind of a handoff to some of the more cyclical expansion stories. This whole theory that we're going to have a little bit better participation from value stocks relative to growth stocks. This chart is kind of evidence of that handoff having already taken place a little bit earlier this year. And obviously we'll continue to follow these trends. This is a chart that I thought was really interesting from S&P Global Market Intelligence, and it shows you the concentration of stocks within these various indices. And if you look at the gray in the middle, this is the S&P 500. So just look at the far right, the top 10 companies in the index represent 29%. Now, if you talk about the S&P 500 Growth Index, which really took off last year, the top 10 companies in that index represent 51% of the index. That's astounding. That is very, very big concentration of potential index performance in a very small number of companies. In fact, if you go to the top five companies in the S&P 500 growth represents 42%. And that's why, in some respects, you could see more volatility coming out of the growth index versus the value. You've got value that much less concentrated in terms of the weight of the top number of companies in the index. So continuing on the theme for equities here, we show you microcaps and the Russell 2000. Again, this is just going back to my chart a few slides ago, showing you that small caps have really just struggled and they flat underperformed the S&P 500. But there's a lot more value here, and you can see that that meandering has taken place for essentially 6 months now. This is a chart that I've shown in the past, but not recently. This just happens to show you the aggregate value globally of negative yielding debt. And right now it's $16.5 trillion. And as you can see, the interest rates are low everywhere, and not just in the U.S. In fact, the U.S. is almost interestingly a bastion of strength in terms of the ability to grab yield across the globe. But there are many other parts of the world, developed world at least, that have negative yielding debt, and this is the indication that that number has been picking up lately. I thought I'd include this chart of collateralized loan obligation issuance. This is, you can see that in that blue line, if you look at the left-hand side, that the monthly CLO issuance is moving higher. In that gray bar in the lower left, we're expecting actually higher overall issuance this year than we've seen in a long time. Now, this represents essentially the ability for small and medium-sized companies to obtain debt, which is then collateralized and put into the secondary market. It's sold, it's packaged into pools of bonds and then sold in the secondary market. And you can see the activity in that area has gone gangbusters, and it just means we've got expansion in the business cycle. So you've got a lot of companies in that kind of fit that size band that are getting financing, not necessarily through commercial banks, but they're getting it through private markets, and in some cases banks that are issuing their own CLOs. But you, on the right hand side, you can see something else which is developing, which is essentially you've got on the upper right hand side that those lines are trending down, and that represents an easing condition. So lending conditions are getting easier on the part of commercial, primarily in this case, commercial real estate loans. And we've seen a huge increase in real estate lending with a lot of this price dislocation that was going on last year. A lot of people speculating that offices were going to be vacant, and everyone's going to be working from home and whatnot. So we've seen a lot of issuance in the commercial real estate sector, and lending standards have gotten a lot easier, while if you go down to the lower right, you can see the demand for those loans has really gone up. So lots of activity in the lending and the non-bank lending sector, and a lot of activity going on in commercial real estate. And here's a look at the European component. So we've been talking a lot about the US expansion, but this is a quick look at Europe, and you can see the expansion is well underway. It has been a little lumpier than it was in the US. In fact, when we had a kind of a second surge of cases in Europe, it really bogged that part of the world down. And so we actually saw kind of net contraction again after the initial recovery. But now you can see that number is really spiking. And on the right-hand side, you can see that retail sales are really moving higher. So this is evidence that that this recovery is certainly in place across the globe, and one of the most important markets for America outside of its direct trading partners, Mexico and Canada, is obviously going to be Europe, and you can see here that Europe is actually doing pretty well right now. Well, in our last slide here, kind of a quick snapshot of the global marketplace. They've got two different iterations of what I'm talking about with regard to this expansion. On the upper side here, we've got the OECD numbers. This is basically developed economies, and it shows here in this chart that we have moved, and this is kind of a track. This chart tracks the index of leading indicators for the OECD, not just the U.S., but for a lot of the developed economies. And you can see that that number has trended into recovery late last year, and now it's basically in a mature expansion phase. So we've recovered, we've moved into expansion. That was in evidence in that last slide when we saw retail sales and basically the European zone, kind of in that growth mode as well. So we're in this expansionary phase, and we've kind of moved out of recovery. And then if you go down to the bottom, you can see here, from a developed country standpoint, kind of where we sit in this expansion phase. And what's really interesting is literally a year ago, we were worried about maybe about bogging down and not fully opening, but optimism was building. You can see the optimism was has certainly manifested into real performance here. And so we're transitioning into this expansion phase, and you can see that other countries are lagging behind us, like Brazil, India, Mexico, for a lot of the obvious reasons, right? I mean, the vaccination rates are a lot lower, and so they're struggling to kind of get out of the starting blocks. But the U.S. and China that have really done a better job on vaccination, we're kind of firmly into this transition phase into expansion from simply a recovery. Well, in our last slide here, I'll talk about something that's a little bit near and dear to my heart right now, and that's cybersecurity. And I saw this from Statistica, and I thought it was interesting. So, we've had a kind of a rash of well-publicized ransom attacks, and I'd say that a lot of small businesses are very vulnerable, and we've certainly taken steps within our firm to try to be more secure from cyber security threats. And I thought this was interesting to pass along. It's just that phishing emails represent the most common cause of these attacks, and these are things that look very legitimate in some respects. I'd say most of them have something that kind of makes you scratch your head and kind of question, but they do try to look really official and legitimate, and if you're not paying attention, they're easy to click on. But in any case, here's a list of those common causes of ransom attacks, and certainly phishing emails are not the only ones. So I'd say to all my business owner friends out there, please be vigilant and pay attention, deploy the cybersecurity measures wherever you can, and I'd say hire a good consultant, because this is a time and in this country where we really do need it. So, well, that will do it. I hope you've enjoyed the presentation. On behalf of the entire team at BKA Wealth, I hope you have a safe week, wonderful week, and we'll talk to you again soon. Take care. Goodbye.